Welcome back to Simply Explain All, where we uncover the financial truths that directly impact your wallet and your future wealth. Let us travel back to the 1980s, a golden era where putting money in the bank was the ultimate strategy. In those days, interest rates soared to incredible heights, sometimes reaching 40%, making simple savings a path to assured riches. For that generation, saving was not just a habit, but a guarantee of prosperity, a secure bridge to owning a home. However, the world has changed drastically, and the financial strategies that worked for our parents are now failing us completely. Today, interest rates hover barely around 2.5%, a negligible return that cannot keep up with the real world. While your savings grow at a snail's pace, the cost of living and essential goods is sprinting ahead uncontrollably fast. Real estate prices have skyrocketed beyond reach, turning the dream of buying a home with savings into an impossible illusion. This creates a paradox where you save diligently every month, yet you become relatively poorer compared to the rising asset prices. We must understand that money in the bank is not safe. It is slowly being eroded by the invisible force of inflation. In South Korea specifically, this economic shift has caused deep anxiety as the traditional ladder of success has been broken down. The balance has shifted against the saver, and holding on to cash is no longer a prudent strategy for wealth preservation. We need to discard the old rulebook immediately and accept the harsh new reality of the modern global financial system. To understand why this is happening, we must look at the bigger picture involving currency exchange rates and global economics. Let us examine the case of Mr. Kim, a diligent saver who believed he was making the right financial decisions. Mr. Kim deposited 100 million won into his savings account in 2022, planning to keep it safe for years. 3 years later, visually, the number in his bank account remains exactly 100 million won. Seemingly safe and sound. He feels secure, believing he has preserved his wealth, but he is unaware of the silent theft that has occurred. The problem lies not in the number of won, but in what that won can actually buy in the global market. Back in 2022, at an exchange rate of 1,200 won per dollar, his savings were worth $80,000. However, as the exchange rate climbed to 1,470 won, the value of his money collapsed in real terms. Now, his 100 million won is only worth $68,000, a massive reduction in his global purchasing power. He has effectively lost about $12,000 or 17 million won without spending a single penny of his savings. This loss is real because everything from energy to imported food costs more when the local currency becomes weaker against dollars. This is the cruel trap of holding a depreciating currency. You save the number, but you lose the actual value. Why is the won becoming so weak? It is not an accident, but a result of specific economic policies and conditions. The root cause lies in the massive supply of money that has been pumped into the economy over recent years. Korea has increased its money supply aggressively, far exceeding the actual growth rate of its real economy and productivity. While the U.S. keeps its ratio around 70%, Korea's money supply has swollen to 150% of GDP. This excess liquidity creates bubbles, driving up asset prices artificially while diluting the value of the money in your pocket. There are two main reasons for this dangerous strategy: maintaining real estate prices and supporting the export-driven economy structure. In Korea, 70% of household wealth is tied up in real estate, making property prices a critical political issue. The government cannot afford to let housing prices crash, as it would destroy the net worth of the entire middle class. Therefore, they continue to ensure liquidity flows into the market, propping up property values even at the cost of currency value. The second reason is exports. Korea's economy relies heavily on selling cars, electronics, and chips to the rest of the world. Giant corporations benefit when the yuan is weak because their products become cheaper and more competitive for foreign buyers to purchase. A weaker yuan helps these companies maintain market share globally, keeping the export engines running despite the domestic side effects. This policy favors corporate exports, but effectively transfers wealth away from the purchasing power of ordinary citizens and savers. The result is that while the GDP might look stable, the average person feels poorer every time they go shopping. This situation raises a terrifying question. Is Korea following in the footsteps of Japan's economic stagnation and lost decades? Japan experienced 30 years of stagnation where asset prices collapsed and never fully recovered, trapping a generation in deflation. Experts warn that Korea is walking a similar path, risking a long-term structural decline known as Japanification of the economy. The continuous printing of money to solve structural problems erodes trust in the currency and delays necessary economic corrections. Time is running out, and relying on the government to fix these issues might be a naive and dangerous hope. So, what are the wealthy and financially literate doing to protect themselves from this looming economic storm right now? Smart money is already moving. They are shifting their assets out of the local currency and into stronger global stores of value. They are accumulating gold and US dollars, assets that have historically proven to hold their value during times of crisis. Look at the data. The price of gold has tripled in the last 5 years, outperforming almost every savings account. Those who held cash lost purchasing power, while those who held gold preserved their wealth and even grew it significantly. The US dollar acts as a shield, protecting your portfolio when the local economy falters or the exchange rate worsens. This brings us to the most important part of this video: your personal action plan to survive and thrive ahead. You do not need to be a millionaire to start. You just need a strategy to stop the bleeding of wealth. First, diversify your currency exposure. Do not keep 100% of your liquid assets in your weakening local currency. Aim to hold 15 to 20% of your assets in US dollars, US stocks, or ETFs that track the dollar. This allocation acts as a hedge. If your local currency crashes, this portion of your portfolio will rise in value. Second, review your debts immediately. If you have loans with variable interest rates, you are exposed to significant future risk. Switch from variable to fixed interest rates where possible. Lock in your cost of debt before market volatility spikes again. This simple step provides certainty and peace of mind, protecting your monthly cash flow from sudden shocks in the banking system. Third, allocate a portion of your wealth to gold. This can be physical gold bars or gold ETFs for easier liquidity. Keep about 5 to 10% of your assets in gold. Think of this not as an investment, but as insurance. Gold has been the ultimate store of value for thousands of years, surviving every currency collapse and empire fall in history. By combining these three strategies, USD diversification, fixed-rate debt, and gold, you build a fortress around your hard-earned financial life. Do not just watch this video and forget. Write down your current asset mix and see where you are vulnerable today. The economic landscape is shifting faster than ever before, and waiting for the good old days to return is futile. The best time to repair your financial roof is while the sun is still shining, not when the storm has arrived. Be like the new Mr. Kim, who adapts to the changing world rather than being a victim of outdated financial beliefs. True wealth is not just about the numbers. It is about the freedom and security that comes from being financially prepared. In a globalized world, your money must be global too. Do not let borders limit the potential and safety of your wealth. Break free from the localized mindset. Understand that you are a global investor the moment you decide to protect your assets. The economy never sleeps, and neither does inflation. Your strategy must be active and resilient to withstand the test of time. Let knowledge be your compass. Educate yourself, stay updated, and do not blindly follow the herd into financial obscurity. We hope this breakdown has given you a clear perspective on why saving alone is no longer enough to succeed. Take control of your financial destiny today. The tools are available. You only need the courage and wisdom to use them. If you found this video valuable, please like and subscribe. It helps us continue to bring you these vital explanations. Thank you for watching Simply Explain All. Stay smart, stay prepared, and we will see you in the next video. Let us dig deeper. We mentioned the 1980s, but why exactly were interest rates so high during that specific period? Developing economies need capital to build factories and infrastructure. Banks offered high rates to attract every bit of savings available. Your money was valuable to them. They could borrow your savings, invest in high-growth projects, and easily pay you back. This was the era of the miracle on the Han River, where double-digit economic growth was the norm, not the exception. But today, the economy has matured. There are fewer high-growth opportunities, so banks have no reason to pay you high interest. Central banks lower rates to encourage spending, not saving. They are effectively punishing you for keeping money in the bank. The system is designed to turn you into a consumer, not a saver. It wants your money flowing, not sitting still. Understanding this structural shift is crucial. The game has changed, and playing by the old rules guarantees you will lose. Let's look closer at the currency issue. The devaluation of the won is not a temporary blip. It is a trend. Demographics play a huge role. An aging population produces less and consumes less, weakening the long-term strength of the currency. Korea has the lowest birth rate in the world. A shrinking workforce means slower growth, which naturally leads to a weaker currency. In contrast, the US dollar is backed by the world's largest consumer market, dominant tech companies, and unmatched military power. This is why, in times of uncertainty, capital flees to the US. It is the safest house in a dangerous neighborhood. We mentioned money printing. When new money enters the system, it does not flow evenly. It rushes into assets like housing. This widens the wealth gap. Asset owners get richer as prices rise, while renters and savers see their money buy less. Economists call this the Cantillon effect. Those closest to the money printer benefit, while the average saver pays the price. The government supports this to keep exports competitive. But a cheap won means you pay more for gas, iPhones, and beef. Since energy is priced in dollars, a weak won acts like a tax on every driver and homeowner in the country. Japan's lost decades meant that wages stagnated for 30 years. Imagine working for 3 decades without a real pay raise. This stagnation creates a society where hard work no longer guarantees upward mobility, leading to social frustration and despair. Notice that while governments tell you to save in currency, they themselves are buying gold at record rates recently. Watch what they do, not what they say. Central banks trust gold more than they trust each other's paper currencies. Gold is the only financial asset that is not someone else's liability. It cannot be printed into oblivion by politicians. Investing in the U.S. market has never been easier. You can buy fractional shares of top global companies from your phone. By owning these stocks, you are owning a piece of global innovation and profits, denominated in the world's reserve currency. If picking stocks is too hard, buy an ETF. It is like buying a basket of the best companies at once. The biggest risk today is not taking a risk. It is leaving your money idle to be eaten away by inflation. Elderly poverty is a real crisis. Proper asset allocation now is the only way to ensure dignity in your old age. We must redefine safety. Safety is not a stable number in a bank book. It is stable purchasing power in reality. Assets like gold and stocks benefit from compounding growth. Cash suffers from compounding destruction via inflation. Choose your vehicle wisely. Start small if you have to. The habit of diversifying is more important than the initial amount of money you invest. Do not wait for the currency to crash or the crisis to hit the news. By then, it will be too late. Also, eliminate bad debt. Paying off a high-interest loan is a guaranteed return on investment that no stock can match. Adopt a long-term mindset. We're talking about preserving wealth over decades, not gambling for quick profits over days. Steady accumulation of real assets wins the race. It is boring compared to gambling, but it is effective and reliable. The definition of money itself is evolving. Staying educated is your best defense against the rapid changes in the financial world. Teach these concepts to your children. Do not let them inherit the outdated saving habits that no longer work today. Join communities of like-minded investors. Sharing knowledge and strategies can help you spot trends and dangers much faster. Korea's struggle is unique, but also part of a global pattern. Understanding the macro forces gives you the upper hand. You cannot control the central bank or the export rates, but you have absolute control over your own asset allocation. Treat your household finances like a business. You are the CEO, and your job is to ensure survival and growth. Remember the 3 pillars. Diversify into US dollars, hold gold for insurance, and lock in fixed interest rates for debt. There is no need to panic. Panic leads to bad decisions. Preparation leads to confidence and ability to weather the storm. The future is bright for those who adapt. The end of the saving era is just the beginning of the investing era. Step forward with confidence. You now have the knowledge to navigate this complex economic landscape and secure your prosperity. History shows that money always evolves, from gold coins to paper notes and now to digital assets and global diversification. In every major financial shift, wealth is transferred from the unprepared to the prepared. Which side will you be on? The choice is yours. You can complain about the economy, or you can adapt and profit from the changes happening. We are closing the chapter on traditional savings. It served us well in the past, but its time has officially passed. Open the new chapter of modern wealth management. Embrace the volatility, hedge your risks, and think like a global citizen. Thank you for sticking with us through this deep dive. We know this topic is heavy, but it is essential. Check out our other videos for more detailed guides on how to buy gold and how to open international accounts. We are committed to bringing you the most accurate and actionable financial insights every single week right here. Your financial well-being is our priority. Let's build a community of smart, informed, and wealthy individuals together. Simply Explain All is more than a channel name. It is our promise to make the complex simple for you. This content was researched deeply to provide you with the facts you need to make your own informed decisions. Remember, this video is for educational purposes. Always consult with a professional advisor before making major financial moves. May your wealth grow strong and deep, like the roots of an ancient tree, weathering all seasons and storms. Thank you for watching. Until next time, keep learning, keep saving smarter, and keep growing your wealth. This has been Simply Explain All. Goodbye for now, and we wish you the best on your financial journey.